Today, I'm going to talk to you about 3 powerful ways to take advantage of volatile crypto markets, focusing on oscillations, overextensions, and positioning. Now, these sound like really weird words to use, but really, this is the way to handle the volatility that happens every single day in cryptocurrency. And we're not going to use fancy indicators. We're not going to use anything that's paid. We're literally going to use everything that's free and available to us here on TradingView. And you don't even need to pay anything on TradingView to do exactly what I'm sharing with you in today's video. But before I get into it, what's up? My name is Aaron Dishner from The Better Traders, and you are watching the Coin Bureau Trading channel. Hit that subscribe button, like the video, and let's get into it. The first thing I want to talk about in today's video are oscillations. What is an oscillation? Well, we're going to start here first with the chart of SEI. SEI has been a great example of an oscillating chart, but oscillations have to do with price action. Now, what I mean by price action is basically all of the ups and downs, the dips, the whips, the pumps, the dumps, all that stuff. Now, we need to focus on specific charts in order to find the best examples of where the oscillations are happening the most. And I want to be clear that this right here is not an oscillation. This is a parabola. That's not what I'm talking about. An oscillation is also not this. This is just dumping. An oscillating chart is going to be a chart that regularly goes back and forth like a sine wave. We want to find charts like this and trade them as much as possible. But the reality is that no chart like this exists at all in crypto. A lot of them go down and they go a lot further, or they pump and they pump a lot higher. But within these moves, there are these little oscillations that happen that allow us to capitalize on all of the volatility, whether it's to the upside or it's to the downside. So we're going to zip ahead to where we are right now with the price of SEI, and we actually don't want to stay on the daily time frame. What I've found is that the faster the time frame, the clearer the oscillations are going to be. So when we zoom out and we look at price action, we can clearly see that we have these repetitive patterns where we see the price going up and down, lurching up and going lower. Now, we can clearly see a pattern happening right here, even starting from back over here, to be honest. But we can see that this has an oscillating pattern where we have lower highs, and we also have lower lows. So we have a channel that's actually moving down. One of the best ways to trade one of these channels is to first recognize what is the trend. Is it oscillating sideways? And as soon as we see the price, as we're taking a sample set like this, and we see the price starting to put in these lower highs, especially about here. And again, this is the hour time frame. So it's going to take us about 12 days to figure out what's happening. But when we start to see price action putting in lower highs, then we can assume that we're going to see lower lows as well. We can see a support level that's established here. And finally, what happens next is we get our lower high. We get our lower high, and it just keeps dropping and dropping and dropping. So one of the ways that you can trade a chart like this is to measure these oscillations. Find out what's the normal amount that, SEI, drops before it bounces. And also, definitely zoom back in time. Even if it's on an uptrend, try to figure out, is there some sort of pattern here? Is there some sort of method to the madness before a chart like this absolutely reverses? And you're going to find a bunch of these moves are not going to be exactly the same, because no chart is going to exactly do the same thing over and over. But what you will notice, the more you do this, and the more you teach your eyes and you train your eyes how to expect or what to look for in these big oscillations, you're eventually going to discover that there are moments in time where this chart will be overextended. And what I mean by that is actually best exemplified if we put on a moving average. So we're just going to put on, we'll just do actually an SMA. So it's a moving average, simple, perfect. We just want something super duper, super really easy. We're going to go into the settings of this, and we're going to put this on a 50-period moving average. Now, why so strong? Why do we want this to be 50-period? And let's change the color so we can see it and also make it a bit thicker. That's a little bit too thick. Why do this? We want to do this because we want to find out first, how much is the price oscillating when we have these big whips and dips, the dumps and the pumps. We want to identify that first, and then we want to use a moving average. Now, the length of the moving average, I just put in a random number here, 50. I could put in 100 if I want. I could do a lot of different stuff. But the main thing you want to focus on when it comes to this is you need to customize your length by the time frame. So if I were to use 100 SMA on the daily time frame, it's going to be a very, very slow moving chart. But at the same time, using like a moving average, like a 9-period moving average, it's basically going to be hugging the chart the entire time. So you want to play with something between 30 and 50. At least in my experience, that works really well, especially on faster time frames. So now that we've measured out all these dips and these rips, now we want to identify moments where the price is overextended. Overextended, back over here, overextended, because these create these asymmetrical moves or these asymmetrical bets, like right back over here, where the price is clearly taking a huge dump. And also to the top side, where we see the price pumping a lot. And when we get these asymmetrical like overextensions from the price, it helps us to identify when a chart is possibly topping out or when it is bottoming out. So the clearer and the quicker that we can identify when the chart is looking really overextended, the better we can actually take advantage of these moves. Now notice that they don't happen every single day. If we zoom out, I'm going to go ahead and hide all of these other price ranges. So we're looking at price ranges, by the way, 22%, 14, 16, 40 was a big move, but we're looking at basically 16 to 24%. We're going to put all these in a folder to keep them for safekeeping. I guess we're going to look at them later. So the point of this exercise is to identify what is a normal range that we see from our top to our drop. And then we start plotting at like 16%. Then we start looking for an entry point. With the moving average on, we also know if we see a move like this that's starting and we measure out 16%, that actually is this exact move. We really don't want to go for this pico bottom. We would much rather try to go inside of that. So maybe like 13%, maybe 14%, but let's just do 13%. And what we do with this on these oversold moves, on these overextended moves, is we want to take a position sizing that will allow us to capitalize on further downside momentum, or what I call negative price action, with an expected take profit target that's reasonable. And usually our take profit target, it's going to be here. It's going to be hovering back at the moving average. This is usually the first touch point. Now this can be done on multiple time frames and multiple tickers, and it's not going to work on everything. But once we have these super asymmetrical moves, whether it's to the downside or to the upside, it allows us to get our expectations in line. It helps us to understand where we can take positions, whether it's going for a long position or a short position when everyone else is panicking. That way it allows us to take an asymmetric bet on what is happening with current price action. So when it comes to moves like this, we also need to consider that text thing I put up here now that I lost it. Because now I changed the time frame. Oh, it's just completely gone. That's so fun. Oh, there it is. Okay. So oscillations, overextensions, and positioning. Now, when I talk about positioning, I'm talking about how much size to put into a specific position. And this is something that I actually talk about a lot in the description of this video below. I talk about trading a lot. I talk about great exchanges to use, whether it's CoinCatch, which is non-KYC, 2-bit non-KYC requiring. Bybit does require KYC, but this is one I use a lot for bot trading on alt trading. And the reason why I'm directing you to this is because there are deals, and we're talking about trading. So you can get these special bonuses by signing up to either CoinCatch or Bybit. And of course, there's access to our course at The Better Traders, which teaches you how to handle negative price action. It's the course called 15 Minutes to Financial Freedom. You get access to it and a 10% discount when you use the special link here on the Coin Bureau deals page. So in the course, when I'm talking about position sizing, I'm usually talking about a DCA strategy. So what I mean by this is that I'm never, ever, ever going to go in with full size. And a lot of you that have been long-term subscribers, you know this. And one simple way to do this is to start with fractions. We're going to use 1/3 for our entry. And then we're going to keep 2/3 for drama, we'll say. Or we can also call this negative price action. We can call this capitalizing on fear, but we want to save some of our position for drama. And the reason why we do this is because many charts that dip will keep dipping and dipping and dipping. Or let's say, for the sake of an example, with this chart, we decide that we want to enter on this capitulation right here, take an entry, and unfortunately, our entry goes up only 3%. Maybe we're dissatisfied with that, but because we've only entered with 1/3 of the total position size, and we see the price go against us by 18%, and we know that the normal move is about 13%, we can tell that this is a super oversold bounce. So what do? Well, we have our 1/3 that's right here that's already entered in. So that means that our 1/3 position size is now in a loss of 17%, but we don't use a DCA. Sorry, we don't use a stop loss. We use a DCA order, and we execute our 2/3 of our volume here. So instead of our entry being right up here, what happens when we DCA is that we actually average down our entry, probably about here. So when the price pumps back up to this smooth moving average or this simple moving average, we walk away in profit. Instead of it actually being in a loss, because we're DCAing and capitalizing on drama, selling back up here on the return to the moving average, boom, there we go. Now, we can't really get away with this when it comes to shorting, because I don't recommend using a DCA strategy when you're shorting. So you will have to use a fixed stop loss, in my opinion, but you can still use the same concept if you want to short the market. Now, Say has been an interesting mover, but let's go ahead and take a look at another chart. Let's look at Fartcoin. And the reason why I want to look at Fartcoin is because this chart has had a lot of volatility. If we just look for a second here at 5 a.m. on June the 27th, in a single candle, it moved at 3.76%. Actually, if we measure from wick to wick, this is a 5% move, almost 6% move. So what we can do with this information is we can say, wow, okay, let's tighten up, let's crank up the length so it's not as generous. I'm going to go ahead and change the thickness here. And that way we can also start to look at the chart and do the same exact thing. We can look for the rips and for the dips. We can look for these moments where the price has been panic sold, and look at this move here on the hourly. I mean, we could actually zoom in more to the 30-minute, but when we get these really big oversold moves like this, we just trade it up to the fast line, and a 2% move like that with leverage can work well. But we want to make sure that we're trying to wait and be patient to look for these moves where these oscillations are happening. So again, it comes down to oscillations. It comes down to overextensions when the price is really far away from the moving average, jumping into those. And it's also position sizing, making sure that we're not going all in on our first entry, that we're reserving some just in case. Now, the last thing that's really obvious about this whole thing that I'm sharing with you is that it will take patience. It will take strategy. It will take following a strategy. If you decide to use something called style drift in this, because you don't like how the market's looking, you're going to end up getting burnt pretty badly. So you need to understand that there's nothing wrong with even getting a really bad entry, because if you have enough patience, you can actually do well. Case in point, I have a terrible trade, admittedly a bad trade. Well, the entry was good. I sold some at about 6%. It went up in total 18%, but I had a target that was just a bit higher here for, say, here on all trading. Now, I even DCA'd, or rather I took my profits here, I reinvested it back into the chart instead of waiting for the pullback. So I'm showing you a terrible trade, and the reason why I'm showing you this is to show you how forgiving crypto is. Yes, we all know how volatile cryptocurrency can be, where we get these dips and rips, and it just keeps falling. I mean, for instance, we're on the 30-minute time frame here. Friday, the 23rd of May, we're looking at Fartcoin at $1.63, and 7 days later, it's fallen 40%. Crypto is brutal, but we also know that just, another 2 weeks later? Well, I guess, 19 days, so 20 days later, the price literally goes right back up. After falling 46%, it rips right back up, which means that you can make a lot of dumb mistakes, like my dumb mistake here, adding in way too early and not waiting for it to fall further, and you can still make out like a bandit. The reality is that if you're going to follow some sort of strategy, whether it's going to be like I have here, and again, this will work for many different time frames, but really it comes down to these three things: measuring out oscillations, making sure that you wait for the overextensions, and then positioning. And you can even enter at one of the worst possible times as long as you are using correct positioning. I've done this plenty of times. Again, case in point, this is a really nasty trade. I should have waited. But even so, when I use correct positioning, I can actually close out in profit as long as I'm patient and I stick to my trading strategy. Now, this is something I've talked about in lots of other videos on this channel. My playlist is a great place to start for learning how to use this stuff. And I want you to watch this video. It's going to pop up right here because this is going to show you how to take profit in bullish markets and even in bearish ones. So watch this video next. And until the next time, you know what to do. Stay awesome and stay in the green. Peace.